I have some rather negative memories of various Octobers, so it does make me nervous. What also makes me nervous is the slowing economic momentum. We have a strong economy for sure, but I think it's decelerating on the back of
Why do you think that?
Fading fiscal stimulus, probably more than anything else. I think the trade talks are a bit of a distraction. If you were a small trading nation, I'd be more worried, but the U.S. economy is just not that dependent on trade. While it makes great drama to talk about the trade, I think the U.S. domestic economy for U.S. equity investors is probably more the issue. That said, you have to understand that the markets lead the economy, not the other way around. So trying to forecast where the stock market's going by studying the economy is like looking in the rearview mirror. But nonetheless, a 10-year-old bull market, an economy that is now well and truly at full employment, Fed tightening. We have some scary changes in the credit markets. It's not outside of the realm of possibility that we get a nasty surprise.
Ed, you say that you're a little nervous about things, but you're still bullish. You think by the end of the year, we do continue to higher levels.
Yeah, we're describing ourselves as barely bullish. So we are
BEAR.
That's right. So we are overweight U.S. stocks in our multi-asset portfolios, not by a lot, but we are basically neutral to underweight international stocks, including emerging markets. So I think there is some evidence, especially outside the United States, that some of the PMIs are rolling over in some of the EFA countries, and emerging markets have a variety of problems, some of which are related to things like the Fed raising rates and some of which are idiosyncratic to each country. So I think it's still an environment where risky assets will give you a positive return, especially U.S. stocks because of the tailwind from the tax cut and other changes in the economy. But I think that the most of the returns we've gotten are already been in the bank.
Is that an argument for telling people don't sell, but don't necessarily put new money to work, or not?
Well, what we're trying to do is position the portfolios so we can still gain some gains if we're right that we still get some higher, but also be prepared for an eventual downturn. So that means a little bit of a barbell approach. So I've been adding a little bit to Treasury bonds within the portfolios, which serve as a bit of a hedge. So you can do some things to try to position yourself or prepare yourself for a downturn without necessarily giving up the upside if we do continue to see some of that stock price move higher by the end of the year.
Chris, what are you telling people? If you're nervous in October, you tell people to get out?
We are very differently positioned. We are very bullish on emerging markets from these levels. Now, it's hard to make a call on stock price movements a month or a year, but the EM is trading at less than half of the U.S. equity market Shiller PE. And from those starting conditions, history suggests that you do much better with the cheaper markets.
Although the reason that they're trading at those levels is because the dollar has risen as our Fed has raised rates. If our Fed continues to raise rates, why is that going to ease up on those emerging markets?
You know, there is a lot of talk and discussion about the problems in emerging markets, and much of it is real, but the problems are in markets that are inconsequential for EM equity investors. Turkey is a 1% position in MSCI EM. Argentina just got put back in. It's a rounding error. There's nothing there. We're really talking about places like South Korea, Taiwan, China, India. And yes, there are idiosyncratic issues in all of these markets. That's what makes them EM markets. But when you can buy at a Shiller PE that is at historical bargain basement prices relative to the U.S., which is trading at a Shiller PE about 30, which is the only time we've seen prices that high or higher was the tech bubble in 1929. Those are not great entry prices for equity investors. So buying half price or less than half price emerging markets is what we're advising investors at this point.